Hello, scholars. I'm here to keep you company again today. I hope you are enjoying this beautiful weather. I'll begin by sharing my screen with you and make sure you can see all this. We have to, okay, good. I believe you can see it now. Um, Again, my name is Joseph AGK OG, and our discussion today will continue from where we stopped in my previous lecture. Now, if you remember or if you recall, our lecture this past few lectures that I have in financial management, we are talking about how to evaluate a company to figure out if it will be a good investment for those of you who want to invest in stock. And also, this can be a lecture that you can use, to do a lot of things about it, evaluating a company, about a company. Now, today we'll be focusing on a different type of ratio that we use to check the vital signs of the company to see if it's a good investment. Um, so the ratio we'll be working on this time is what we call the asset management ratio. The asset management ratios. Now, the asset management ratios, we use these ratios to measure how effective that a company is managing its assets. I mean, how effective they are using their assets to generate sales. Now, at the end of the day, everything boils down to sales. You have a product, and but a good product, but for some reasons you are not making sales, or the customers are not buying your products. They are not voting for your product with their money or with their dollar. That means you don't have a business. You need to do something to push up sales. And of course, not every sales is good one, because if you are selling but you're not making profit, you also don't have a business. So you set the price that is appropriate, that will also guarantee you some profit, and then you do whatever you can to generate sales. So this asset management ratio tell us how good a company is in doing that. A company that is doing that well is a good company to invest. Some analysts use this ratio to value a company and decide whether to buy their stock or not. Now, so the asset management ratios, sometimes we call them efficiency ratios. These ratios, like I said, they are good because they mean that if you have a high asset turnover ratio, that means that your company is utilizing its assets efficiently to produce sales. So that means generally higher asset turnover ratios or management ratio is good. So that means, but low asset management ratios are not good because it means that the company is it is inefficient with respect to using the asset they have to generate sales. Okay. Now we have. Okay, I'm gonna make sure you're seeing this. We have four key asset management ratios that we examine today. The first one is the total asset turnover ratio. The second one is the fixed asset turnover ratio. The third one is days sales outstanding. And the other one is the inventory turnover ratio. Let us look at these ratios one by one, okay? Now, the total asset turnover ratio, usually we use this ratio to check the ability of the organization or the company to efficiently produce sales by using their asset base. So it tells us, compare the company's sales versus the asset base to see if the company is actually generating sales. using the asset. So if you have a ratio, if the answer is 1 or more, let's say 1, that means that the company is generating equal average total assets. The net assets of the company equal the asset base. Usually, a ratio that is bigger than 1 is best. Is better. It's best actually. Let me put it that way. Let's try an example. Like I said, I'm going to do the example with a real life company so you can see how these things work. Now, the formula for that we use to calculate the total asset turnover ratio is sales divided by total assets. Okay. So I hope you are ready to work. So let us begin work. I'll get my pen. Now, all the information we need for this, like I explained in my previous lectures, we get those information from the financial statements. And I told you that there are 3 major financial statements: the balance sheet, the income statement, and the statement of cash flow. So we're going to be using the Walmart and other companies, other balance sheet from other companies that we have, because I want to compare the Walmart for 2020 and 2021, and then compare the performance with other companies as well. So let's look at it this way. Again, you can see the balance sheet. This is the income statement for Walmart, and then this is the balance sheet for Walmart. Let me see. Balance sheet for Walmart. See? So we're using these two to get our ratios. So like I explained, we were using the year 2020, 2020, 21. Usually we start from the current year to the previous year, 2020. Then I'm going to compare Walmart with 2 other companies. I'm going to put Walmart. I'm going to do Target. And I'm going to pick a company that is not in the same industry, because Walmart and Target are in the same industry. So I'm going to put a company that is not the same industry. So I'm going to put something like let's say Ford, a different industry. Now, as an investor, you're not supposed to put all your money in one industry. You have to spread it. We call it diversification. We'll come to that eventually. So we begin our calculations. For Walmart, remember that the formula is total assets, sales divided by total assets, asset turnover ratio. Let me write it down, and then we'll do an example using Walmart and the rest of these companies. Total assets turnover ratio, okay, is sales divided by total assets. Okay, this is for 2021. We can then do it for 2022. Sorry, for 2020. You always compare it with the previous year. That will show you if the performance is improving or not improving. Okay. Now let's see what we have for Walmart and then other companies that we need to evaluate. So we have, first of all, we have sales divided, and then total assets. And we have the total asset turnover. Asset turnover ratio, okay? Now, let me make this good for us. Make it enough space here. Okay, good. I'm gonna make this one bold because so that it will be clear for all of us to see. Good. Now, from income statement, from Walmart's income statement, we'll get that the total assets. Oh, sorry. Let's go to the income statement and get it from there. I actually prefer to use income statement for this, so I'm gonna copy this. then we can go back and forth to the balance sheet. Okay. So for Walmart's income statements, I'm gonna put it right there. Okay. Everything is okay, good. So that I can move this up. Okay. Move it back. Okay. All right. Now I can make them bold. Okay. Now we are about to do our first calculation. I was just arranging things for Walmart. The total asset turnover ratio for Walmart. That's what we are going to calculate, and then we calculate for other companies that are in the same industry, and for one company in the different industry. So we can now compare. Now, for my total sales, we can get from here. Excuse me, it says I have to share this. I want to make sure everything is working right. Good. Now, so for Walmart, it is, look at the sales, the net sales. You can see from here, net sales for 2021. And net sales for 2020. Remember, all these are in millions of dollars. Okay. Now, so let me see. For this one means you have to add 3 more zeros. Yeah. So they're all in millions, actually not more than 3 more zeros. So they're millions. Now, we have the total assets. That information we can get from the balance sheet. So I'm going to write 2021 and 2020 for Walmart. So I'm going to take you to the company's income balance sheet, so I can get the information I need for the total assets. We look at Walmart. Okay, you can see that the total assets is right here. Okay, total assets. I can copy it and then go to the income statement and paste it. Okay. Good. Now with this, we are ready to do the calculations. Equals, it is called, the answer says, the formula says sales divided by total assets. So it is sales right here divided by total assets. Give me 2.19 all the way to the, they give it all the way to the almost 6 decimal places. But I want to highlight this and make them just 2 decimal places. I'm going to format these cells and just make them 2 decimal places. Okay. 2.0. Well, the same thing is surprising that they have the same thing number for those 2 years. Remember that this year we're not even gone half of it yet, so it might change eventually. We're just 5th month inside into 2021. So this is the assets turnover ratio for Walmart. Now, what does this mean for Walmart? Okay. Now, this means I will show you the result I have on the PowerPoint. But actually, this means that Walmart, for each $1 of fixed assets, of total assets, Walmart is generating $2.20. So this means that if Walmart has $1 million in assets, it is generating $2,200,000 in sales. See? Now, of course, we know that Walmart has more than that. So if Walmart has $1 billion in assets, that means it is generating $2.2 billion in sales. It is using that asset, to generate sales. So let me show you more of this. Then we can do more examples with the two different companies. So this is good because it shows that, like I said, Walmart is generated so far this year, it generated $2.20 in sales for every $1 invested in assets. Now, when we compare this to 2 years that we have in the spreadsheet, one is for the whole year for 2020. See that it's just a coincidence. The 2021 that value can change because we are, like I said, we are not even half of the year yet. Now let us compare Walmart. Well, actually, I did it here. So let's compare Walmart to other companies in the same industry. So for Walmart, let's say 2021, we have this information. I'm going to put this here. Walmart. Then I'm going to go get the information for Target and the Ford so that I can compare which of them is generating more sales from their assets. Now for Target, to get Target, I'm going to write it down here. Target have sales over total fixed assets. Total assets. So now we have for targets. So let's see if you can get find target. The way to find target is to get the financial statements. I'm going to get it from Yahoo Finance very fast. We'll take it to Yahoo Finance, and then we can see what they got there. So you have finance, yahoo.com. So targets, let's see targets. Targets corporation. You can see from here. Have Target corporation right here. Okay, let's find their financial statements. Look at their financials. Okay, for 2021, this is the income statement. I need the annual, but we are still in the second quarter, so I'm going to use quarterly so that you are comparing them within the same period. Okay, quarterly. Now, this total revenue they have here is revenue from sales. So that means revenue sales will be 93. You can see right here, 561. Okay, in the example I have with Walmart, I removed the last 3 zeros. Okay, and then total assets. So I'm removing 3 zeros because it's the same thing I did in the Walmart financial statement. Total assets, cost of total assets we get from the balance sheet. Okay, again quarterly. Okay, total assets. Again, we're removing the last 3 zeros. If you like, you can keep the last 3 zeros. It doesn't matter. It's just that I removed it. I did it in Walmart. I removed the last 3 zeros. So I'm going to do so to make the calculation easier and faster. Okay. That asset is right here, 51, 284, 248. Okay. Now, so I'm going to take you there. So we have it here. Put them in the spreadsheet we have here. Sales is 93, 561, and then total assets we have 51, 248. And let's do the same for Ford. Ford, we go to Yahoo Finance again. Yahoo Finance and find the Ford's information. Ford, the trading symbol is F. So I'm going to put F there to bring Ford Motor Company. You can see right here, Ford Motor Company. Then we can look at the financials to see what they have. The income statement first for Ford. I have, okay. We have sales. For Ford, I'm going to use sales again, quarterly statements, because we're comparing the 2021. I have it here. I have total, okay. Total revenue for sales. This is as of 31st of March. So I'm going to remove the last 30 again. It's 36,228. And of course, then the balance sheet, we get total assets. Okay, we have here, I remove the last 3 zeros, total assets equals 267, 261. Okay, so I'm gonna go there and put it in 267, 261, put it in the spreadsheet. Sales 36, 228. Then we have 267, 261. Now we can now calculate the total asset turnover. Total asset turnover ratio equals sales divided by total assets. Then once we do the first calculation, we can just copy the formula to the other two, and it will carry out the calculation for us. And again, like I say, we can now format the sales, make in 2 decimal places. So you can see from here very clear that Walmart performed better than the other 3 companies. Walmart generated so far this year $2.20 for each $1 if they invested in their asset base. Target, in contrast, generated $1.80 for each $1 they invested in their fixed asset base, their total assets. So that means then Ford generated the lowest, only 14 cents for each dollar they invested in the total assets. So it's supposed that Walmart invested $1 billion in total assets. It generated $2.2 billion in sales. Ford generated, as soon as they invested $1 billion in total assets, they generated $1.830 million in sales, which is still good. But Ford generated less than they invested in their total assets. So they're not really generating enough money from their total assets, of course, which is very understandable, because Ford has been struggling for years, for some years now. But the automobile industry has been having a problem for some time now. So now that is how you use total assets turnover. I hope you enjoy this topic, this part of the ratio analysis. Now let's look at other asset management ratios that we have today. The first one is the second one is the fixed asset turnover ratio. This ratio is basically to help us to determine this how successful a company is with respect to using their fixed assets to make money. We're using their fixed asset to generate sales. So how good are they at doing that? Now, the formula is this: fixed asset turnover ratio is sales divided by net fixed assets. So I'm gonna we usually use this ratio for manufacturing companies, but that doesn't mean we cannot use it for that industry. You can still use them for sales, because services is also a part of production. Now, so let's see how we use it. But before then, I want to explain more thing. Higher turnover ratio, for this particular ratio is good, but lower one is not good. Okay. The ratio of 1, for example, means that the net sales of a company equals the average total assets of the year. Then, if it's a company is generating $1 of assets sales from every $1 they invest in their fixed assets, that's what it means. So let's see use it for apply it for Walmart. So I'm gonna take you back to where we use it for Walmart, and then we can do the calculations. Put this. Okay. I'll copy all this. Copy this. Excuse me. Okay. Now I have it here. Okay. Now let's see. If you look at the formula for this, it says it is sales over total fixed assets. Now over net fixed assets. Net fixed assets, which we're going to use here is the net plant and equipment. Okay. That's the fixed asset we have for Walmart. Net fixed asset we have for Walmart. So now we have the okay, excuse me, I think I click on the wrong thing here. Okay, good. So we have sales. Oh, okay, that means I want to share it again one more time. Okay, something is okay. Let me do it again. Okay. All right. Now sales over net fixed assets, which means we're gonna type in the sales here. Sales. We're just doing it for Walmart, so we're gonna remove all this. But I always recommend do it for all the companies that you want to put your money in. Do the same ratio analysis for them, then you can compare and choose one. For example, based on what I have here, I will choose Walmart and Target. Then I will not choose Ford. Now remember, this can change. Ford might do some project that might cause their total asset turnover ratio to go up. That time, Ford will now become a good investment. Then you buy it. Okay. Sales, we have net fixed assets. Fixed assets. So for Walmart, the sales, I can copy it from here. Make sure you're seeing this. Okay. Because there's sales for here. I can copy it from. I can even copy it all the way to year 2019. And put it right here. Okay, paste it. Now, for net fixed assets, that's one you cannot get from income statement. You can get that from the balance sheet. So we go to the balance sheet for Walmart. Like I said, net fixed assets we use for Walmart to be the plant, say, property and equipment net. So I use this. We have it for 2 years. Okay, I'm gonna copy it. Then take you to the income statement. Where are we now? Paste it here. Okay. So with this, we are ready to calculate our what do you call it again? The fixed asset turnover ratio. So fixed asset turnover ratio will be the fixed assets turnover ratio. Okay. Let me make this on bold. Since we don't have the 2019 data for Walmart, so in the fixed assets, we have to remove that one. So now you can see I have equals sales divided by net fixed assets. And then you can now copy it to next. You can see that there's an improvement. Walmart this year, I'm going to highlight it so you can see it properly. This year, 2020 was 4.94. That means for Walmart generated $4.94 for each dollar they invested in fixed assets. Now, in this year, current year, we are not even gone halfway. It has so far generated $6.02. Let me make them 2 decimal places. Okay, must make it 2 numbers. Okay, all right. $6 from so far for each dollar it invested in fixed assets. I have it more as well explained here in the PowerPoint. So there's an improvement from between 2020 and 2021. See, $6. So this value, it means that, like I said, Walmart generated $6.02 of sales for every dollar it invested in fixed assets, which is good. Now, like I said, if you want to value other companies, evaluate, see how they are doing, you can calculate this ratio for different companies, all the companies that you are interested in, that the ones that are doing well with respect to generating sales from their fixed asset. You can say, okay, if you have enough money to put them, you can spread their wealth. So, like I said, ratio tell us if the company is doing well or not. Now, the third liquidity, the third asset management ratio we're looking at again is the one we call them the days sales outstanding, or we call it the average collection period. So this basically tell us number of days it takes a company to collect cash from credit sales. So a company that the creditors pays on time, we now use that money to do more projects and invest and generate more wealth for the shareholders. So if your customers are not paying on time, that means if there's an opportunity to make money that comes out, you won't have enough money to take advantage of it. For example, if a company is going bankrupt and their customers pay on time, usually when companies go bankrupt, they sell their assets, inventory at a discount. So if you have the cash, you can buy it at a discount and then sell it at a normal price and make a lot of money. That's how many companies get big. But if your customers are not paying on time, you'll be cash strapped. So that's why this ratio is very important. If customers are paying on time, they like your product, that means the company will grow because it will keep buying, investing, and buying assets at discounts and making more money. So the days sales outstanding, the formula is receivable divided by average sales per day. Now, which means that we have 365 days in a year. So we have receivable divided by annual sales times 365 days in a year. So let us calculate this for Walmart. So I'm going to take you to the spreadsheet again. Receivables. I'll put this here. Okay, 2021, then 2020. So we have receivables. Okay. Then we have our after receivables, we have our annual sales divided by 365. 1 minute. Just 1 minute distance. We have annual sales. Then days of the number of days. Okay. Now for Walmart, the receivables, you can get the account receivables. You can get it from the balance sheet. Okay. Go to balance sheet. You can see the account receivable. You can see the receivables net. I'm gonna copy it. Okay. Now okay. We're still there. Copy it and then paste it in the income statements. Okay. Now annual sales you can get from I'll make this bold. Okay. Annual sales you can get from the income statement here, Walmart. Now annual sales, you can see the sales right there. It's sales. It and then paste it there. Okay. So we can cut this one 365 days in a year, 365 days, 365 days. And then 365. so that they sell outstanding, they sales outstanding you have equals annual sales, receivables divided by annual sales divided by 365 days in a week, in a year. Okay, and then we have it here and make it 2 decimal places. Okay, now this is there's the answer to that. You can see that in 2020 Walmart restocked, sold out 4 times for the whole year. That means the customers paid in 4 days. Now this year we have not gone half of the year yet. So far, just halfway, we already have 4.4 days. That's customer paid in 4 days. We don't know what it will be at by the end of the year. But last year is understandable because we have a pandemic, COVID-19 pandemic, so sales were slow. But here, halfway, just halfway, not even halfway, the year have 4.28. Now, these results for Walmart for 2021 of 4.28 show that in 2021 so far, Walmart approximately 4 days. It took it 4 days only to collect cash from its customers. So suppose Walmart has, let's say, a credit policy of 30 days. That means that customers are paying their bills on time. So it's they sell out, and then Walmart customers pay on time, and then they sell out. The Walmart customers pay the bills on time. So they took the customers an average of 4 days to pay their bills for their credit. So of course, this applies to business transaction. But let's say Walmart sold some school supply to elementary school or the library, and they in bulk, then the library pay back in 4 days, or the elementary school pay back in 4 days. That's where this applies to, not to business of customers per se. Because as a customer of Walmart, you go to Walmart, you pay as soon as you are checking out from the counter, you pay immediately. But for business to business transaction between Walmart and another company, this is where this kind of applies. Now, okay. Now the last ratio we look asset management ratio we look at today is the inventory turnover ratio. This ratio tells us how good or how effective inventory is managed by the company. This shows that how many times inventory is turned or sold during a period. This is very important ratio because how a firm manages inventory. If it's good, it means that the company can sell the inventory and restock many times during the year. So if the company can't sell their inventory, it will incur what we call the storage costs. So if you cannot sell it in the inventory, and the inventory tends to tie down the money that the company might need for future projects. But the main thing that's one thing actually. But the main thing that if you keep on doing, you're not making sales and restocking and selling off, that means customers for some reason are not buying your products. Something is wrong. You have to start digging to see why it is like that. Now, when we talk of that the inventory, when you have excessive inventory, you incur holding costs. Those holding costs include the cost of storage, of course, security, because you have to secure the inventory if you store them, and then insurance in case there's a fire hazard, and of course you have a protection for the other expenses. You have to manage the inventory as well. So that's why this is a company wants to keep on selling off, restocking, selling off. That's how you make money. Now, the inventory turnover ratio. There's 3 ways analysts use to calculate this. They can just use cost of goods sold, or they can call it cost of revenue, because that revenue comes from sales. So that's why cost of revenue divided by the inventory. Or I can say cost of goods sold or cost of revenue divided by the average inventory, which you can say inventory at the beginning, inventory at the end, divided by 2. So that's why I broke it down here. That the cost of goods sold over divided by the beginning inventory plus the ending inventory. Now, these two, you can use the inventory, at the beginning of the year, and then the inventory at the end of the year to, calculate it. But I'm going to make it simple. The simplest way is to use the first formula, which is cost of goods sold divided by the inventory. Now, for Walmart, we're going to figure it out right away. The inventory turnover ratio for Walmart. Okay. Let's see. Now, if you look at the income statement, you can see that the Walmart, you can see that the cost of goods sold. See, cost of sales. You can see right here. I'm gonna copy it. Walmart. Okay. Cost of sales. I'm gonna put it right here. Okay. 2020, 2021, and 2020. Now, so you have the cost of sales, cost of goods sold, and then I'll show you something about the inventory, of course. Now, the inventory for Walmart, we can get from the balance sheet. Cost of goods sold divided by inventory. The inventory, okay. Then inventory turnover ratio. Inventory turnover ratio. Okay, I'm gonna make it a little bit bigger. So let's see the inventory. We can get the inventory from the from balance sheet. Okay, that's where they have the information about the inventory. Walmart balance sheet. So Walmart balance sheet will give us right here. The inventories are right here. So you can see it right here. Inventory. This is right here. Copy it. And then I'll take you to the income statement where I'm doing most of the calculation. I'm going to paste it here. Okay. So the inventory turnover ratio now become equals cost of goods sold divided by the inventory. So again, once you do the calculation, you can just copy it to the next cell so that you can calculate it for the other year as well. I usually like to format the cells to make them to the smart places. Okay. Now, this tell us a lot about the company. So the first one is this. In 2020, Walmart sold out inventory and restocked the company. It sold off everything and restocked it 8 times. Or I will say approximately 8 times. This year so far, we're not even gone half of the year. You have sold out 9 times and restocked. That means that it's improving and it's doing well. Now, if you want to see how other companies are doing, you can just list their names here, like I did in the first one. You can put Target, Ford, Costco, Facebook, whatever. Facebook, we don't have inventory per se. So we may not use this the inventory turnover ratio for a service company like Facebook. But you can use it for grocery stores, manufacturing companies, and so on and so forth. Anyway, now, so that's why 1 minute, I think I made a mistake here. Okay. So that's why here you can look at the example we did for Walmart. You get 9.3. So Walmart inventory is sold out and restocked 9 times in 2021. That means people are buying for Walmart. So this is where we conclude our asset management ratios for today. Our next ratio we'll be examining will be the debt management ratios, but that will be for our next lecture. I hope you enjoy this lecture, scholars. I'm welcome to any questions. If you can't get my ask now, you can email me the questions later. And those of you who are interested in investing in stock market, this is how you can check. One of the ways you can check how good the company of your interest is doing. And again, once again, my name is Joseph Oji, and I thank you for listening, and you have a good day. Bye-bye.